without further ado, please give Ian a warm welcome to the stage as we talk about the media business, disruption and growth.
Thanks very much, Steve. No pressure on things. So I've got 15 minutes, so I'm going to go through what I see as the main themes for the media sector moving forwards. Just a bit about me. I was a city analyst for 20 years. I covered the media and tech. I was twice analyst of the year across all sectors. 3 years ago, I just decided to set up my own advisory consultancy firm. And I do a couple of things, sort of as you can see there, including sort of now training on how to speak the language as a CFO, which has been a topic that's been mentioned a couple of times. So I'm going to give you some thoughts. I'll leave a sort of a minute or two for Q&A as well, just where I see the future of media and tech moving forwards. The first thing I'd point out is, and again, it's a theme that has been coming through, is what I like to call de-siloization. What do I mean by that? Well, the whole sort of thing seeing analog and digital in terms of the barriers there, that will continue to break down and so forth. What is quite interesting, though, is that, and I'm sure you will have much greater knowledge of this than I will do, is that de-siloization is still not complete. So you've got things such as the old newspapers, magazines, majority of their revenues are still digital, and yet when you think very much from an advertiser standpoint, certainly when it comes to the media buyers, there is still very much of a structure that is sort of outlined on the old ways. Now, again, change always sort of takes time to come through and so forth, but this trend is only going to continue more and more, where essentially the whole idea that we have analog and digital media, that will become increasingly obsolete over time. Even for something like TV, those numbers are probably too conservative now in terms of where television is. ITV, probably around 22, 23% of the revenues come from the BVOD side, sort of, and it's growing substantially. So one thing I'd say from this is there probably needs to be reform of the media buyers to come through to fully take this into account and fully pass through the benefits to the various platforms. Advertising. So I'm actually an optimist when it comes to advertising, and that's been my view really for the past 2.5 years. That essentially, yes, there has been concerns about recession, and there is the danger you talk yourself into recession. But the key thing to remember about advertising is businesses spend on advertising. So when people talk about consumer confidence and so forth, it's actually not consumers who are spending money on advertising, it's businesses. So it will really be about what businesses are feeling about the environment. If you look there, here's from the US, most of biggest companies sort of come out of there. US corporate margins are probably at something like a 75-year high, sort of when we look at things. If firms actually, their corporate profits are high, they will continue to spend on advertising. Now, there's no signs at the moment that that is coming under significant pressure. There are some isolated examples, but certainly if you look at the last results season, again, you had sort of a beat. If you looked across markets generally, there were more beats than there were misses on here. So I think moving forwards, you're likely to see sort of, again, firms continue to spend on advertising, particularly in sectors such as CPG, where actually what they've turned around and said is, we've been able to push through much greater price increases than expected on there. And the core reason we've been able to do that is the strength of our brands. So there is now this direct correlation between advertising and the bottom line. Agencies, I think, would be quite interesting. I mean, typically what happened from a agency results standpoint is they generally tended to act as a pack in terms of the results. There wasn't a huge amount of difference between the two, or between the various groups. But if you look here, this is looking at the first quarter and the second quarter results. Apologies for some of the formatting on there. There's been a real difference there between them. So if you take the best performing group, which has been Publicis, over 7% organic revenue growth in Q2. You take Dentsu, which is actually the worst, down 4.7%. That sort of 12% gap between the best and worst performing agencies and organic revenue growth performance, that's pretty much unprecedented. And what that would suggest is that you're starting to see the different types of business models starting to bring about change in results. So obviously Publicis has gone more for the tech focus side of things with Sapient and Epsilon. If you take, for example, WPP, so that you would argue it's maybe more focused on the old-fashioned is probably too harsh, but it's more focused on the creative and the media side of things. I think this sort of divergence in trends is only going to continue moving forwards. It's also reflecting the share prices as well on there. that you can see the difference between WP and Publicis in share price performance over the past 5 years, probably around 50% on there, which again is unprecedented. I bring this chart up because if you look at we'll talk a bit more about broadcasting in a moment, but one of the things that has been talked about this year is, are we now talking about the structural decline of TV again, given the sharp falls that you've got in TV advertising, which do seem to be running ahead of the falls in audience. And the one thing that would ask you to remember on here is bear in mind that actually, particularly TV, but advertising in general, and I think it's also one of the reasons why, one of the part reasons why you had that divergence in performance for agency organic revenue group is that a lot of the tech companies were very, very heavy spenders on advertising throughout back end of 2020, 2021, and the first half of 2022. So this is from ThinkBox. So in terms of the highlights on here, 2021, tech company, they call it online born companies. So this is everything from a Google and a Facebook to sort of startups that start up online and then went somewhere else. 2021, those online born companies were 21% of all linear TV ad spend. And that trend probably continued through in Q1 and most of Q2. There was 42% growth in that sector, the online born companies, in 2021. That was a massive driver, particularly for TV, but also as well for other sectors. And so what has actually happened in 2023 is a comparables effect. As interest rates have gone up, so what you found is many of those tech firms have had to pull back spending because essentially their backers have said, we're going from a growth strategy, we're now going to cash preservation. So literally for many of those companies, the funding stopped overnight. The point being about this chart is to say, if people are turning around and saying what's happening in TV this year is essentially because of people are buying into the structural argument and they're taking money sort of out of TV, actually it's probably got more to do with this. That what you've got is one specific sector that was a very strong spender on the area has now dramatically pulled off its spend. So for 2024, the comparables should look better. And sort of mentioned TV as well. This is from Ofcom in terms of their numbers on here. What you are starting to find in terms of the linear declines, and look at the purple chart, both the darker purple and the lighter purple there. You go back to 2017, you look at for a TV and BVOD altogether was around £5.11 billion in the UK market. If you look at now 2022, 5.38. So okay, I mean it's not, there's some growth there. It's not fantastic growth, it's not spectacular growth if you do the rate over the past 5 years. But what it does show is that TV still is actually sort of maintaining its absolute spend. That's got some interesting questions as well, I think, for particularly I think for the online companies. If TV manages to actually maintain its spend moving forwards, the likes of Facebook and Google, they've taken all the money they can from newspapers and directories. TV is the next big pot. And they're pretty much relying on TV spend actually collapsing in order to maintain some of that growth. Be interesting to see what happens over the next couple of years with that. But at the moment, TV in terms of absolute revenues is managing to keep its share. So I think the structural argument against TV has been somewhat overblown. So on the other hand, I mean, those who've heard me speak at events over the past couple of years, know sort of I'm quite negative on the SVOD model. And I think there's more and more evidence coming through that essentially, if you look at SVOD, that essentially it's peaked in terms of the market. So if you take the US, probably in terms of SVOD penetration is around 87, 88% of households. There's really not that much more they can get out of there. Now, in terms of Europe, with SVOD, what it seems to be like is exactly the same situation that you had with the old pay TV model, that Europe has a lower structural penetration rate than the US, and it was around 20, 25% in the old days. Similar sort of thing if you look at here. This is for the UK. Again, it comes from Ofcom, but you can see there now that really over the past 2 years, the SVOD penetration rate has flatlined. And I don't think there's going to be any reason why it would necessarily go up. Those people who want SVOD, they've got it. Okay? What else is there going to be out there that is essentially going to attract big audiences in? There probably isn't. And that leads on to another point that would say is that often one of the sort of issues that people have is, and it was one of the big structural mistakes that the SVOD companies made, they're all based out of the US. They all looked at the world as though it was an extension of the US without actually realizing that particularly in TV, but all other parts of media as well, there are notable geographical differences between sort of our various markets. So what we'd say is, you look at the US TV market, yes, this is showing the various audience rates, streaming up to 38% share of audience. That's definitely not the case in Europe. One of the biggest mistakes that I think people make sometimes is to assume that what happens in the US will happen in Europe. It's actually not the case if you go back. What's more likely to happen is the two will have different geographical trends. Fast. People always sort of talk about it as though, fast is going to be the next new thing that comes on. The question again that would have it is in the European markets, why? If you've got a very sort of big, what essentially is a public sector broadcasting environment on there, where you've already got free TV ad supported revenues, why is fast actually going to come up? Why are these new channels going to come up? The answer is they're probably not on here. So again, US, totally see why fast would make sense. Just given the structure of the pay TV market, it's very expensive. People historically paid over $100 a month for their pay TV services. When it comes to the European markets, there's far less rationale to go through. I say on this in terms of tech, if you look at the 2010s, what happened was the tech sector obviously sort of blew up in terms of both, blew up in a growth sense, not an exploded in smithereens, in terms of the growth rates of the revenues, and then also as well in terms of their share prices as well. A lot of the reason for that, there's been a feeling that what happened with tech was almost inevitable, that it was sort of meant to be that you will get Google and Facebook actually take a hell of a lot of share. What we'd say with this is actually in 2010s, there was 4 factors that came together, which if 1 or 2 of them had been missing would have meant that tech wouldn't have got the penetration it did. Namely ultra low interest rates, an ultra liberal regulatory and political environment, particularly out of the US, on there. The rise of 3G and particularly 4G when it comes to mobile, because essentially the telco operators enabled a lot of tech to come through with their apps. And no disrespect meant to the people from the publishers on the front, but there were bad strategic decisions made by publishers, particularly when it came to the late 2000s and early 2010s. The environment this time round is a lot different. Crucial fact, interest rates not going back to the way they were. I think they'll come down next year, but they're not going back to the 0% they were sort of in 2021, 22. The fact is, from a valuation standpoint, very low interest rates benefit tech, because without getting into the whole detail, and we haven't got much time, essentially when you have ultra low interest rates, it sort of maximizes the value that you get in the outer years. And so for tech companies, of course, where they say it's growth now, it's losses now, but our future profits, yet in an ultra low interest environment, the present value of those future profits is maximized. When interest rates go up, even by a small amount, those future profits get crucified from the present value. So you've got that factor. You've got the factor also as well, quite frankly, that this chart here, what it shows is the performance of IPOs. Most of them were tech. Most of them lost investors' money, a huge amount of money in terms of this. There's going to be a lot of investors who are going to be very, very careful about getting back into the sector, even with areas like AI. The other fact you've also got as well, capital is limited. So there's not an endless pot of money like there was 2 years ago. And what you've also got now competing for those pots of money, areas like defense, areas like energy, infrastructure, all things that 4 or 5 years ago nobody really cared about. With what's happened on the geopolitical environment, it's completely changed on there. So tech is going to find it a lot harder, I think. Both the big tech firms, I think their valuations will come under pressure, but particularly on the startups, they're going to find it a lot harder to actually get money. Oh, God, sorry. There we go. Retail media. Obviously a big growth area at the moment. These are the figures for Amazon and Walmart, their growth rates. Amazon don't split out their profits, but fun fact, advertising probably now makes up around more than 50% of Amazon's profits. It's absolutely crucial to the group. Their e-commerce business probably loses, and this, I always say this is not investment advice. My guess is, or my estimates, it probably loses around $10 billion plus in terms of the e-commerce arm. Yeah, it's AWS and advertising that is really keeping Amazon up on here. But the reason why you've got the likes of Walmart and suddenly a big amount of interest coming through in retail media is because many of these retailers, it's very, very profitable compared with their core businesses. A grocery chain will only make around mid, high single-digit margins. Walmart there is 4% on there. A&A calculated that the advertising sort of margin on retail media is around 50 to 70%. You don't need much in revenues to actually make a difference in terms of profits, which is that sort of line there in terms of the theoretical point. So you could get this being less than 1% of revenues for Walmart, but you might get it being 15% of overall profits if they can grow. That's going to be of interest to a lot of firms. I think on this, it's really only been the biggest players that will be able to do it, because retail media, to me anyway, seems like search. And as you've seen with search, the benefits disproportionately go to the largest players. Sorry, I've done it again. AI, I'm actually quite skeptical on AI in terms of things. Not necessarily that I don't think it will be important, or that firms will sort of, they're obviously going to implement it. You can see here in terms of conference calls, everyone's talking about it. It will feed through into the models. But I don't think it's going to be transformational in terms of businesses. I don't think, for example, AI is going to enable Bing to knock Google off the number one platform. What I think actually Microsoft is hoping is that essentially what Bing will be able to do is consolidate all the smaller players in the market and become a strong number two. And if they can do that, there's probably around $10, $15 billion of extra search revenues for Bing off the back of that at quite a high margin. So that is worthwhile in itself. But I see AI as more evolutionary rather than revolutionary in terms of things. And in terms of, even on the creative side, I think probably if there is going to be a risk is that people think that AI can do more than it actually can, sort of on here. So, my feeling on this is see how it develops, see what sort of what happens. But I'm not thinking, for example, at the moment this will be a transformational thing. Out of home, very positive on. I think one of the benefits of the pandemic for out of home was that essentially it made many advertisers realize that as people came back out of the pandemic and out of lockdown, that they were going outside. What's a great medium for actually getting people who are outside? Out of home advertising. And so the recovery has been quite strong. It's driven by what's happening in digital as well on there. And there's still some scope to come through. But structurally, I think that's a growth business. I'm going to end with three quick slides just about how to get your message across. As I said, sort of, I teach on how to speak the language as a CFO. And these are sort of 3 points I'd consider. One is to say, this whole idea looking at marketing as an investment, not a cost. Actually, very good timing here because you had Tesco CEO with their results, Ken Murphy, turn around and actually make that statement. He said, to us, marketing is an investment, not a cost. Now, if you look at Tesco's results, they beat expectations. They raised their full-year operating profit guidance. So there's a company that's continued to spend on advertising, actually spending more on advertising. The end result of that, they actually beat their forecast both at the revenue line and the profit line. So there doesn't have to be that sort of split. If you spend more marketing, it impacts your profitability. Actually, what it does is sort of it moves it forward. I will show the chart there because also as well it shows the importance of language. This is of CFOs and sort of their views on, you can see capital expenditure and discretionary spending. The problem for the moment for marketing is it's lumped in with discretionary spending on here. CFOs generally see discretionary spending bad, capital investment good. The task is to actually get marketing to be considered in that investment category and not that cost category on there. Once you can get that kicks in, and I think a lot of that is changing now because we were saying with Nick before, you look at the past 18 months, there's been a vast unplanned experiment in showing how brand strength works. All the CPG companies that have been able to put through much greater price increases than expected without the impact on the volume, all of them pointed out that it was the strength of marketing that enabled them to do that, the brand strength that has come through. So you've got your evidence in real life results. You've got your evidence that actually contributes to the bottom line and the share prices on there. So this, I think, will be an increasingly easier argument to make. I always like to say that advertising intangible capex. What I mean by that, firms build physical capex, factories, to build cars, but they realize there's a cost in the short term, but it's actually, they get much greater return in the long term. It's the same way when it comes to brand strength as well, marketing. Similar sort of thing. You invest now, you get the benefits coming out over the future. There are also as well some quite useful parallels from this. One is you wouldn't, or not if you're smart, you wouldn't actually sort of not maintain your factory because sort of it would, the cost of repairing it would be greater than the actual benefits you get. Same with brand advertising. Also as well, sort of in terms of things, you wouldn't necessarily go with the cheapest cost. And I think that is one thing that has happened with the advertising industry. It's allowed particularly the creative side to be seen as a commodity rather than actually something that adds value. And the final sort of point that would make know your audience about this, again, one of the things that emphasize to people is, look, if you're in marketing, and you're trying to make the case as to why you should spend more on marketing, you've got to know where the sort of key decision makers are coming from. What's their priorities, what they're thinking. So I always say, great sort of resources, things like annual reports, transcripts, but also as well, don't miss out on the what they get compensated by, because that will actually sort of influence people. I put this for BT on here because if you look at their bonus, this is the bonuses for financial year, look at the top line. 35% of the weighting towards management's bonus is adjusted EBITDA. Now, if management wants to meet the target on adjusted EBITDA, the easiest way to do that is to cut their marketing spend. So if you're dealing with a management who essentially is incentivized to do that, the key is then to come back with arguments to say why you shouldn't do it and so forth. Don't take the quick hit in terms of the revenue line. There are reasons why you should consider to spend that. But the more that you can actually work out what they're thinking, what's driving their priorities, and that will include sort of what investors and analysts are thinking, and also as well what their targets are, the better you'll be able to actually push your message. And that's it. Have we got time for Q&A or not? Have we got time for questions or not? I don't mind. Yeah.
We've got a couple of minutes. Did anyone have any questions for Ian at all? Can we get the mic on, please? Is it on?
Hi. So various people have been speaking to me. My name's Neri. I'm actually an accountant. And one of my big things that I've been talking about for the last few months, really, has been so I've been speaking to CFOs who are in e-commerce retail. They literally said to me, we've just put £1 million in a campaign. We do not understand what we've just spent this money on. And they, it's, the KPIs, because they keep coming back to me, KPIs, ROIs, all of those things. None of that has been feeding through. And, we've seen the KPMG study about the relationship between the CMOs and CFOs. It's not been as great as it should be.
Yeah.
So what are the conversations you've had and where it's been effective? Because, historically they've said the Boots CFO, CMO one has been brilliant, and there's been a few. So where have you seen it's worked, and how have you seen it worked effectively? Because when I've been speaking to my other CFOs, they've said it's not working.
Yeah, I think that is quite interesting. You look, that sort of, as it were, breakdown between the CMO and the CFO is common. And it's been in other studies as well with the IPA and EFT, the board brand rift. I think a lot of the problem is the language. One CMO that particularly rate, he's now sort of departed his line, was Mark Evans, direct line, and they were very good at actually tying in what they did with the sort of the marketing objectives with what essentially the firm needed in terms of the results. And it's almost as what you do is you're there, and then you work backwards, and then you think about your marketing plan. Without going into details, because obviously that example, I don't know sort of what were the conversations that I'd have. Certainly in terms of, from what I've heard before, one of the biggest problems is just that the two are different, speaking on completely different levels. So you've got CMOs that obviously speak in a way, in a language, and use phrases that don't necessarily sort of correlate with what the CFO is thinking. And I think also as well, the other thing that would highlight, and I have seen, without sort of mentioning names, I have seen time and time again, one of the things that sort of people always tend to focus on when they look at models, 90% plus of people do this in terms of models, they focus on the output. So that's the core thing that they actually look, what's the end result, and so forth. What they don't question, and what's actually key to any model, are actually the inputs and the assumptions that have gone into it. And I think what has happened is that there's not been enough work on sort of stress testing those assumptions, those inputs, see how rigorous they are, see how they sort of tie in with what the firm's trying to do, and so forth. And what everyone has gone for is we're trying to actually say we should spend more on marketing. Let's just grab whatever resources we can and so forth, and then push it into the CFO, and it works. Every CFO, CEO I've spoken to has been, what we need is we need something that's credible. We may not agree with it, but if we go and ask a question, sort of how effective is this ad spend, that the person who responds to it says, they come back with an answer that we can go, you know what, they thought about it, they thought about what we're trying to do, And yeah, we may not agree 100% with us, with what they've said, but we can see their rationale and we can see what they've thought about it seriously. And I think that's, yeah, my experience from speaking with them, that's probably been the key issue.
Unfortunately, we
all
are
right.
going to have to move on. That's absolutely fine. But are you around for the rest of the day, Ian? For a little bit?
Most of the rest of the day, yeah.
Well, then grab Ian if you've got any other questions later on then. Thank you ever so much, Ian.
No problem. Thank you.